Nobody tells you this part. Not the books, not the seminars, not the financial content flooding your feed every morning. Nobody tells you that one of the most important skills in building lasting wealth is the ability to tolerate long stretches of nothing happening. No dramatic moves, no exciting decisions, no visible progress. Just the quiet, unglamorous, deeply unfashionable discipline of staying still while everything around you demands that you move. That discipline has a name that nobody in finance wants to market. It is called boredom, and it may be the most underrated financial advantage available to any investor. We live in an era that has declared war on stillness. Every platform, every algorithm, every notification system has been engineered to ensure that you are never more than a few seconds away from something stimulating, something new, something that produces a response: curiosity, urgency, pleasure, outrage. It does not matter which, as long as you remain engaged. This environment shapes behavior in ways most people never stop to examine, and nowhere are those effects more financially destructive than in investing. Because the market does not reward stimulation. It does not reward activity. It does not reward the investor who is most engaged, most informed about daily movements, or most responsive to what is happening this week. The stock market rewards patience more often than intelligence. And patience, real patience, the kind that holds a position through years of apparent inactivity, is almost impossible to maintain in a culture addicted to immediacy. Think about what modern financial culture celebrates. The trade that returned 40% in a month, the investor who spotted the trend early and moved fast, the portfolio reshuffled in response to breaking news, the constant search for the next opportunity before this one gets crowded. This is the financial equivalent of entertainment. It is stimulating. It produces stories worth telling. It feels like mastery, like someone who understands the game well enough to move at speed. But the evidence does not support the mythology. Study after study in behavioral finance has produced the same uncomfortable finding. The more frequently investors trade, the worse their long-term returns tend to be. Not marginally worse, significantly worse. The activity that feels most like competence is often the activity doing the most damage, and the discipline that feels most like passivity, buying carefully, holding patiently, reinvesting quietly, is the one that creates the most durable outcomes over time. The activities that build wealth rarely provide immediate emotional rewards. That gap between what feels productive and what actually is productive is where most financial futures are quietly decided. Warren Buffett has described his ideal holding period as forever. Not a quarter, not a cycle, not until sentiment shifts or a better opportunity appears. Forever. That is not a throwaway line. It is a complete philosophy, one that reflects a deep understanding of how compounding actually works and what it requires from the person allowing it to operate. Compounding is not exciting in the present. It is only exciting in hindsight. A 10% annual return feels almost meaningless in year one. It is background noise. It is the financial equivalent of watching paint dry. But sustained across 20 years, that same return multiplies the original capital nearly 7 times. Sustained across 30 years, it approaches 18 times. The mathematics are extraordinary, but they require something most people find genuinely difficult to give: long periods of apparent inactivity during which the instinct to do something, anything, must be persistently resisted. Charlie Munger put it plainly. He said that the big money is not in the buying and the selling. It is in the waiting, not the analysis, not the strategy, not the insight, the waiting. Here is the psychological reality underneath this. The human brain was not designed for long-term compounding. It was designed for survival, which means it was designed to respond to stimulation, to seek novelty, to act on new information, and to interpret inaction as risk. In environments where threats were immediate and resources scarce, these instincts were enormously valuable. In financial markets, they are enormously expensive. Every time the market drops sharply, the instinct to act, to sell, to protect, to do something is not a signal of financial intelligence. It is an ancient threat response, firing in a context it was never designed for. Every time a new investment trend generates excitement, the instinct to participate, to buy what is rising, to be part of what is working, is not conviction. It is the brain's reward system responding to social proof and stimulation. These impulses are not weaknesses of character. They are features of human psychology operating exactly as designed in the wrong environment. The investor who understands this has an advantage that no amount of financial analysis can replicate, because the greatest challenge in investing is often doing nothing. And doing nothing in the face of noise and fear and temptation requires a clarity about long-term purpose that most people never develop because nobody teaches them to. John Bogle spent his career making a case that the financial industry spent enormous resources resisting. His argument was simple. Most active managers, over long periods, Do not outperform the market after fees. The investor who buys the whole market, holds it, reinvests the returns, and ignores the noise will, in most cases, outperform the investor who is constantly trying to beat it. The industry hated this argument because it was not profitable to sell. Boring index funds generate minimal fees. Simple, consistent, patient strategies do not require advisors, analysts, or annual portfolio reviews. But the evidence supported Bogle with a consistency that was hard to argue with. The strategy that worked best was also the strategy that felt least like doing anything. Buy, hold, wait, repeat. No narrative, no drama, no excitement. Just the slow, invisible accumulation of ownership in productive businesses, compounding across decades. Most fortunes are built during years that feel uneventful. This principle extends well beyond investing. Consider how the greatest businesses in modern history were actually built. Sam Walton did not build Walmart through a series of dramatic pivots and bold reinventions. He built it through relentless operational consistency, the same fundamental model, refined and repeated, city by city, decade by decade, long after it stopped feeling like a new idea. Ingvar Kamprad built IKEA across 50 years of the same obsessive focus on cost efficiency and accessible design. Not 50 years of reinvention, 50 years of deepening commitment to a single, well-understood idea. Amancio Ortega built Zara into one of the most valuable fashion businesses on earth. Through a supply chain model he spent decades perfecting, not through excitement, but through the discipline of continuous, unglamorous refinement. These are not stories of visionary leaps and dramatic breakthroughs. They are stories of extraordinary patience applied to fundamentally sound ideas. The excitement, if it existed at all, was internal, the quiet satisfaction of watching a system work, year after year, in ways that only become visible from a significant distance. Consistency, it turns out, is not the absence of ambition. It is often the highest expression of it. Marcus spent years looking for the version of investing that felt worthy of his intelligence. He traded actively. He followed trends. He moved in and out of positions based on what was generating conversation and producing short-term results. Every new strategy felt like a breakthrough until it didn't. Every portfolio change felt like a correction until it needed correcting again. He was busy. He was engaged. He felt like an investor. Daniel did something that looked from the outside almost embarrassingly simple. He invested a fixed amount every month into a small number of diversified positions. He reinvested every return. He did not check his portfolio daily. He did not adjust his strategy when the market fell. He did not chase what was working for other people. He held. For years, the difference between their positions was small enough to seem irrelevant. Then compounding did what compounding always does. It accelerated. And what had seemed like Daniel's passivity began to reveal itself as something else entirely. It was discipline, dressed in ordinary clothes. There is a question worth sitting with. What are you currently doing with your financial life that feels exciting and is costing you compounding? Not because excitement is always wrong, but because the emotion of a financial decision is almost never a reliable signal of its quality. The trade that feels urgent rarely is. The strategy that feels slow rarely stays slow. The investment that feels boring in year 3 rarely feels boring in year 15. Ray Dalio has spoken about the importance of understanding that most people overestimate what they can achieve in the short term and dramatically underestimate what they can build over decades. The gap between those two time frames is where impatience does its most expensive work. Peter Lynch, who managed one of the most successful funds in history, identified one of the most common investor failures as selling winners too early and holding losers too long. Both decisions driven by emotion rather than logic, and both rooted in the inability to stay still when stillness was the correct strategy. The financial future most people want is available to most people, but it requires them to do something that the modern world has made genuinely difficult. It requires them to be comfortable with boredom. Boredom, in the context of wealth, is not emptiness. It is a signal that the system is working. It is the absence of noise that allows compounding to operate without interference. It is the psychological environment in which good decisions are most likely to be made because they are made from clarity rather than stimulation. The investor who can sit with a well-constructed portfolio during a market decline without acting, without adjusting, without reassuring themselves through movement, that investor has developed something that cannot be taught in a seminar or extracted from a chart. They have developed the capacity to let time do what only time can do. And that capacity, over a lifetime, is worth more than almost any other financial skill. Wealth is not usually built in the moments that feel significant. It is built in the ordinary ones: the month you invested when nothing interesting was happening, the year you held when everything suggested you should sell, the decade you allowed to pass without redirecting capital that was already compounding toward something that felt more exciting. The dramatic moments get remembered. The quiet ones do the work. And the person who understands that, who can find peace in the process rather than demanding constant evidence of progress, is the person for whom time becomes the most powerful asset in their portfolio. Not intelligence, not timing, not access to information that others don't have. Time, and the patience to let it work. That is the uncomfortable, unglamorous, deeply unfashionable truth about how wealth is actually built. Not with excitement, with boredom. Chosen deliberately, sustained consistently, trusted completely. If you want to understand how the world's greatest investors and business builders use patience, ownership, and long-term thinking to create extraordinary wealth, watch the next video now. Subscribe to The Equity Mind for deeper insights into wealth creation, investing, ownership, and financial intelligence. Because in a world obsessed with excitement, the patient often inherit the future.